From the Penn Institute for Urban Research and the Volcker Alliance, this is Special Briefing. I'm Bill Glaskell, and today we're looking ahead to 2026 with our expert panel and, of course, with our great co-host, Penn IUR co-director Susan Wachter.
Good morning, Bill.
Good morning to you. We have lots to talk about today because when we think about what lies in store for 2026 for America and its states, counties, and cities, a word cloud comes to mind. Words like new federalism, midterm elections, wrenching change, inflation, recession, and maybe even an economic upturn. It's kind of a jump ball. And while states and cities are still pretty flush with cash, they'll need to be very nimble to deal with cuts to Medicaid, food stamps, or SNAP, as it's known, and FEMA, not to mention education and other areas, as the White House and Congress realign the federal government's support of local spending. Our special briefing mavens are raring to dig in, but first, this word. Special briefings are made possible by funding from the Travelers Institute, the Volcker Alliance, and members of the Penn IUR Advisory Board. We're coming to you live on the Penn IUR and Volcker Alliance websites, and also on the Special Briefing podcast and Penn IUR YouTube channel. And we've taken your questions in advance. I see a bunch already on dealing with natural disasters at the state and local level, so let me introduce our panel and get down to work. We'll get the latest on the U.S. economy and how low interest rates may fall, or not fall, from Apollo Global's Torsten Slick. Then, as a record-breaking year for muni bond issuance draws to a close, Matt Fabian of Municipal Market Analytics will tell us if even bigger borrowing lies ahead in the new year. Following Matt, and for how the shift in federal responsibilities, as Eric put it, and how this may impact states and their creditworthiness. For this, we'll turn to Eric Kim at Fitch Ratings. And unfortunately, Terrence Muda, who we promised you for this panel from National Association of Counties, is stuck in the snow somewhere in a travel hang-up and won't be able to join us, but we'll certainly get to her next time.
Thank you, Bill. Let me introduce Torsten.
Good.
And Torsten is a long-time panelist, and we're so pleased for his joining us today to bring clarity to the fog of macro. Torsten is a macro guru. Torsten, tell us what your forecast is.
Well, thanks so much, and thanks for having me, Bill and Susan. So the short version of the outlook for the economy in 2026 is that we come from a year where the trade war was dominating all conversations. The fear was in the spring and the summer that the trade war would have dragged the economy down much more than it ended up doing. So the economy did go through this year with somewhat weaker growth in total. Offsetting the trade war, we had the AI boom. We had strong spending on data centers, strong spending also associated with that on the energy build out. And looking into 2026, the lagged and delayed effects of the trade war and trade war uncertainty should be more and more in the mirror. So the outlook for 2026, especially combined with the One Big Beautiful Bill, is actually beginning to look better and better. So this is therefore the consensus view and our view that GDP growth will begin to accelerate over the coming quarters, and perhaps most importantly for this conversation and for muni bonds, that the level of yields and the level of inflation is likely going to stay higher for longer, simply because we still have an inflation level that is at around 3%, not quite back to the Fed's 2% target. So the outlook for 2026 is quite simple. A little bit stronger growth over the next several quarters, getting better and better, partly driven by the One Big Beautiful Bill, partly driven by the trade war more and more behind us. But at the same time, the level of yields and therefore the level of borrowing for state and municipalities is going to stay elevated for an extended period because inflation has just not quite yet come down to the Fed's 2% target.
So, Torsten, just to go back for a moment, what did we get wrong? The consensus was that trade was going to pull down the economy in 2025 and add to inflation in ways that it didn't actually.
This is a very important question, but there are two reasons why things turned out to be better than what a lot of us, including I, feared earlier this year. Number one is that the tariffs that were announced on April the 2nd were not the level of tariffs that ultimately were implemented. So in other words, the magnitude of the shock that was hitting the economy actually ended up being a lot milder because the rise in tariffs was actually not as bad as it was feared in the beginning when Liberation Day came around. So think of this as an economic model. You give it a shock, and if the size of the shock is smaller, then the amplitudes that the fluctuations you're going to see are also going to be smaller. So the first reason why the trade war and trade war uncertainty did not slow things down was because that the size of the shock that ultimately hit the economy, namely the level of the increase in tariffs. Yes, there was more of an increase in tariffs than we expected in the beginning of the year, but that rise ultimately ended up being less than half of what was announced on April the 2nd. And the second reason also why the economy ended up doing better was that what was also happening in the meantime was that, yes, there was a trade war shock, but there was also significant tailwinds coming to AI. And importantly, despite that the Federal Reserve had raised interest rates, normally our textbook would predict that when interest rates go up, then business spending, such as business spending on AI, should be going down. But the key issue with AI is that that's not financed by interest rates directly, at least not for the better part of this year. But AI was financed by equity valuations. And given that equity valuations went up so much, that meant that there was a strong need and a strong desire to do the data center build out, no matter what the Fed fund rate was doing, no matter whether there was a trade war happening in the background. We have to invest in AI and we have to invest in data centers. So this strong tailwind and this strong investor appetite for investing in AI and associated energy meant that there was also strong growth in capex spending. And associated with that, when stock prices went up, there was also strong growth in consumer spending because of higher stock prices. And all those things were helpful in offsetting the negative effects of the trade war. So in summary, the trade war was dragging things down, but at the same time, AI and data center build out was pushing things in the opposite direction.
So, Torsten, you have basically a bullish outlook. Can you give us your GNP forecast for 2026?
Yeah, so we expect GDP over the next several quarters to begin to gradually increase from roughly 1.5% in the first quarter and then go up towards 2 in the middle of the year and 2.5% in the second half of the year.
If I may follow up with that for just one more, I know, Bill, you have a question, but following up, the AI, you attribute much of the growth of 2025 to AI. And it sounds like you're attributing 2026 to AI as well. But how much to AI and how much to One Big Beautiful Bill?
Yeah, so this is very important, and this is exactly a critical quantification. And what's also important about this discussion is that that requires AI to continue to deliver on earnings expectations. If we get a correction in the stock market where the Magnificent Seven are not delivering earnings as markets are expecting at the moment, then for sure we will also begin to see a slowdown in the money that goes to data center and the energy build out. And we will for sure also begin to see a negative impact through the wealth effect on consumers. So the answer to your question is that the Congressional Budget Office have estimated that the One Big Beautiful Bill will lift GDP growth by 0.9% in 2026. Remember, GDP growth normally grows around 2. So if roughly 1% of that comes from the One Big Beautiful Bill, that's a very, very meaningful boost to GDP growth coming in 2026. So from a taxation and from a state and municipal government perspective, that means that tax revenues should actually begin to pick up as we go through 2026. That also means that if we begin to work tax collections, including on housing, property taxes, including, of course, on value-added taxes, all those things are at least looking. I know there's constantly discussions, and I know we'll talk a lot about this also today, about the fiscal challenges at the muni level, but the tailwinds from a macro perspective continue to be fairly solid with this backdrop of the trade war being more behind us, and now the One Big Beautiful Bill and the data center build out helping in terms of raising tax revenue for state and local governments.
So, Bill, I have follow-on questions, but I'll turn to you.
Well, let me just butt in. So how much of this is linked to the accelerated depreciation provision in the One Big Beautiful Bill and the investment-driven growth, and how much is it going to be linked to consumer-driven growth because consumers are also getting increased state and local tax deductions, increased standard deductions, senior deductions. There's a lot of tax goodies packed in there.
Absolutely. So that's why to the 0.9% calculation from the Congressional Budget Office, most of that comes from the accelerated depreciation, exactly as you're highlighting. The new thing that starts on January the 1st is that if you have a business and you would like to build a new factory, well, you can immediately write it down 100% and deduct it from your taxes. That's normally something you have to do over a schedule of many years. So therefore, this is incentivizing businesses to go out and invest. So that also, of course, raises the likelihood that we will not only see capex spending on AI and data centers continue, but now we might actually also see capex on other types of investment by businesses. So that's why the tailwinds are beginning to look stronger when we look in, especially to the side of the capex. But also to your question, there's also coming some relief on the taxes for consumers, which also, of course, should be helpful for consumer spending. So overall, the number of tailwinds that are building from the One Big Beautiful Bill, combined with the data center build out, the energy build out, and combined again with the trade war being further and further behind, all that argues for a nice, steady, and accelerating growth as we go through 2026, which of course is good, again, for tax collection and tax revenue for state and local governments.
Yeah, but you did publish five risks, at least one of your many emails. Said here's Dr. Sluck's five risks. So what are the what are the footnotes in that
Well, the
very
main
bullish
footnote to
forecast?
this, and I know there's always, as always in the economics and financial markets, there is no free lunch. And the risk, of course, here where there's no free lunch is, of course, that if we get a really strong economy, that might bring the Federal Reserve back in hiking mode. I know that sounds like a completely different discussion today relative to where we are at the moment, but it is very clear that if we have a lot of tailwind and things really begin to accelerate and businesses begin to spend because now they can do that more freely with a lot of tax reasons to continue to spend more money into their businesses. That, of course, runs the risk that we might begin to see some upward push on inflation again, because the backdrop for this discussion is also inflation is, unfortunately, remember inflation was 2% for 20 years, then it went up to 9 during COVID, now it's down to 3. So that means that we're just not quite down at 2 yet. And if we now have a strong economy and a risk of therefore also higher inflation, then the biggest risk to this outlook is that it comes with the likelihood that the Federal Reserve will have to come back and raise interest rates again. And not that that's an unmanageable risk, but that begins to become important for the muni world, because that means that the level of yields that we are beginning to plan will then, of course, be higher because the base rate will be higher.
Well, we have a president who wants lower rates no matter what, and it
That's
is
why
on the
maybe
verge of appointing somebody
now
as
I
Fed
know we have to
chair.
get to the other speakers here, but that's why the other risk that, of course, also important in this context is that remember Jay Powell steps down in May of this year, and when Jay Powell steps down, of course, we'll get a new Fed chair, and the question is, will the new Fed chair come in and try to persuade the other FOMC members to cut interest rates dramatically? And if that were to happen, the upside risk to inflation, of course, is even bigger. So that also therefore comes with the ultimate risk that maybe the yield curve could throughout 2026 begin to steepen because the Federal Reserve could be cutting interest rates. As a result, inflation could be higher. And as a result, we still have a big federal fiscal problem, which also argues for higher long-term interest rates. So the biggest risk also from a muni and a markets perspective is that we have a steeper curve, which is my expectation as we go through 2026.
So, Torsten, we have a bit more time because we know you are leaving. So we can, if you don't mind, we can expand on this a bit. Because I'm
Please.
very interested in, you are not in following up and carrying on what you're just speaking about inflation. I take it you're not an adherent of the concept that some are, that the higher the growth rate, all else equal, the lower the inflation. Because there's a sopping up of real growth of money supply. Is that, you're not agreeing with that, or you are?
Right, Susan. No, I'm more the old school textbook, and I would say the Fed textbook, which would say that if you start overheating the economy, and if at the same time immigration restrictions have been limiting the amount of labor that comes in. Remember, the last 3 years, net immigration into the U.S. was around 3 million workers every year. Now the Congressional Budget Office is forecasting that net immigration will drop from 3 million a year coming into the country to now only 500,000 coming into the country. That means that you will begin to see the risk of shortages of labor, especially in the sectors where unauthorized immigrants are working, namely hotels, restaurants, agriculture, construction. So this is also beginning to put some overheating pressure on the economy, that we simply have less labor coming in relative to what we've had for the last several years. So no, I do
So
worry a
following
bit
that up,
about.
for a moment, inflation expectations do seem relatively contained.
That
Do
is exactly right. So that's why the Fed allowed themselves to cut interest rates, of course, last week. But this is why the question is, can we continue to have that? And as we know very well from the financial bubbles and the crisis literature, that just like Greece in 2012, it wasn't a problem, it wasn't a problem, it wasn't a problem, and suddenly it was a problem. So this is why inflation expectations, there have certainly been no problem, no problem, no problem. But if we suddenly get some policy changes, if we begin to see some incoming data change, of course, the risk could be that they could also begin to move higher.
And
So
one final question on the inflation aspect. Do you, and interest rates, which then, of course, are directly related, do you see that the Fed perhaps has some tools up its sleeve to change the cost of debt by quantitative easing or some other mechanisms and to compensate for a potential response if this bad outcome occurs?
yeah, so I do think that if we have a really, really bad situation like in 2008, the Fed will basically pull out all the stops and do whatever is needed. But at this point, it is also very important that a decision about interest rates is taken with a vote on the FOMC where there are 12 voting members. But a decision of QE and buying long-term government bonds and therefore putting downward pressure on the long-term level of yields is also done by vote of the 12 voting members. So that will also require persuasion for the Fed chair to try to force the other FOMC members and make them agree to the view that we should also be doing QE to lower long-term interest rates. So I think that there will only be consensus on doing that if we have a really, really bad economic situation. And that's obviously not what we're expecting. But therefore, I do not think that they will be doing QE or long-term asset purchases and therefore buy the long end of the yield curve unless we have a bad situation, really bad
And there
economic
really are
situation.
disagreements on QE too, and it's not just it's not by politics, it's other drivers of these different reasons. And one more comment, and then I'll turn back to Bill, see if he has other questions, and then we'll go on to our other panelists. And I know you must leave, Torsten, unfortunately. I don't hear a recession threat.
That's right. If you look at the latest estimates that actually just have come in from the consensus, they estimate that there's a 30% chance of a recession in the next 12 months. So on my team, we spent some time staring at that number and saying 30% chance of recession, that's really high. I mean, the stock market's at all-time highs, credit spreads are very tight, the economy seems to do being well. Yes, the labor market data that came out today was a little bit mixed, but it's still okay because now we have less immigration, and with less immigration, then job growth of 50, 60,000 a month is actually exactly what the break-even rate should be. So that's why the recession probability, in my view, is lower, only around 10%. But why is the consensus worried about a 30% chance of recession? My guess is, and this is also the important backdrop for going into next year, that if AI does not deliver, and if suddenly AI valuations go down and therefore less spending on data centers, less spending on energy, stock prices correcting, and therefore consumers have less money to go out and spend, that they've been making wealth effect benefits, of course, to the economy also. All those things combined could raise the risk that maybe the risk why people are so worried about a recession coming is because of growing fears of AI not delivering the earnings that are priced in at the
So as
moment.
our non-diversified, we are an AI economy in terms of our growth going forward.
That's exactly right. That's exactly right. We're not very diversified when you look at growth in capex at the moment because it's all data centers and energy, and also growth for consumers. It is to a large degree driven by the upper end of the K, meaning high income households that have seen stock prices go up and therefore also outspending. So if those two things happen, namely that we see a rollover in AI, that both consumer spending goes down and business spending goes down, then that might be the fears that people have and therefore the elevated risk of a recession.
Last week, in addition to the Fed's rate cut announcement, announced that they're going to essentially start buying Treasury securities again, adding liquidity back into the market. We've heard a lot of concerns about a lack of liquidity, and maybe that's one of the reasons why the yield curve is where it is. So is this just a temporary thing in your view, or does this morph into what Susan was talking about? I think what the term used is financial repression, Susan.
This is a very, very important discussion, and so the overarching issue here is this issue of are there enough reserve balances in the banking sector? In other words, do the banks have enough basically think of it as cash available to run the economy. Or do they have too little or do they have too much? So in the Federal Reserve language, that means are there ample reserves or are there scarce reserves? And what we've seen is that the amount of, think of it as cash and dollars in the banking sector to help the economy do what the economy does has been going down as the Fed has been doing QT. They've been sucking liquidity out of the economy. So what they did last week was very unusual. Namely, they decided to say, well, now we are buying 40 billion, but only in T-bills. So they were saying this is not quantitative easing. We're not supporting long-term interest rates. We're not doing this for political reasons. But to your point, Bill, we're doing this to help money markets and ultimately also to help muni issuers so that there's more stability in interest rates in the front end of the yield curve. So you are asking how long time will this continue? I think they will continue to do this at least for the next 6 months, but they will definitely continue to make sure that interest rates are as stable and steady and as close to the Federal Reserve's target as possible. And for issuers in muni bonds, this is of course very helpful because the more stable and steady and secure the environment feels, then of course the more you're willing to issue. If of course interest rates in the front end start to do like this, then that might begin to have some issuers in commercial paper even, but also in muni bonds say, you know what, I'm not issuing in this market because I don't know if I'm issuing up here or if I'm issuing down here. So that's why it's very desirable for the Federal Reserve to get this problem under control. And what they did by buying 40 billion in T-bills is likely going to solve the problem. So that's why I'm optimistic on muni issuance over the next several months, simply because the Fed has now made the yield curve, especially in the front end, much more stable than it has been for the last several months.
Well, that's going to make Matt Fabian very, very happy, I think.
So
Because he's
we're turning to Matt now in a moment, but Torsten, thank you so much for being with us today. We'll have you back soon, I hope, and to see whether your forecasts, which are so positive, bring us a
Thank
good,
you.
happy,
and happy,
but in any
happy,
case, good and happy New Year to you.
happy,
And
Happy
happy
holidays.
holidays.
we turn now to Matt Fabian, another wonderful long-term guest, and we thank you for being with us again. Matt will take us to the muni market. Matt is going to give us the municipal market analytics, which he heads up, forecast for the year for muni markets, and also perhaps some counter, or maybe he confirms what we just heard from Torsten.
I mean,
Matt?
I just love hearing someone saying that they're optimistic about Muni anything, right? And so that's just kind of warms my heart, right? It's a little chilly out there. It's a nice hearing Torsten talk about that. And I don't disagree. We are generally very optimistic about the year ahead as far as the market. Of course, that depends, right? When we're talking about market expectations, you have to be very specific what we're talking about, right? So I am optimistic that issuance will continue to grow, right? We think that there's going to be another record year ahead of us in 2026 as far as dollars of bonds sold. We think that the market will internally remain sort of, well lubricated, nice flows of investor cash into the sector, not necessarily anything building as far as, that would drive investor dollars out of the sector, just from the muni perspective. When you talk about optimism as far as prices, I agree with Torsten, right? Which is not necessarily an optimistic perspective as far as bond performance, right? I think also I agree. I mean, we don't work together, obviously, Torsten and I, and I'm free to disagree with him as much as I want, but I have a hard time disagreeing with almost anything that he said. A reasonable outlook where interest rates, in particular at intermediate and longer maturities, begin to rise or are, pressed a little bit higher. That seems about right to me. I do think, for me, I have a base case that the new Federal Reserve Chair will cut rates at the president's behest, and so the front of the, regardless of what else is happening in the world of data, so the front of the yield curve will is most likely to continue to steepen from where it is, and then that means the intermediate and longer yields will also begin to rise, and an overall steeper yield environment, which I think is sort of endemic of the situation that we're going to see going forward, and that the market, the muni market at least, and that's where I'm expert as opposed to the other markets, but in the muni market, I think endemic curve steepening going forward as a function of sort of all of the bond issuance that needs to be processed, the concessions that the issuers of bonds need to make to investors to make sure that they have them, right? That there are participants who are willing to transact, to underwrite, to distribute, to trade all of these bonds. It all means that yields have to be as high as they have been, maybe go a little bit higher. Yeah, so and from a credit perspective, right? And I'll let Eric talk more specifically about credit, but from us, just to reference what Torsten had been talking about, reasonably or reasonable economic growth. I think he said, wait, what did he say? He said at one point he said exhilarating growth, and that shook me a little bit. But beyond that, right? He said, otherwise he confirmed it to like a 1.5 to 2.5% annual growth. Great, right? I think that that's fair. And inflation pressures generally rising. Inflation has um, 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 uh, grown state and local tax revenues, right? If things are more expensive, then taxes on those things grow, right? So one of the major reasons that we are this year headed for, like, still potentially this 2025 is still in the running to have the lowest number of municipal bond defaults since 2009 when the data became available. So one of the reasons that that's true is because inflation has, elevated state and local tax revenues and helped paper over other potential challenges that have emerged. So we are generally optimistic on, aggregate credit quality, right? Overall, with, we can talk more about issues specific to that, specific within that later. But bullish on issuance, bullish on distribution, less bullish on prices, right? We think that total return expectations, and let me just say before the cues start here, but I think that in the past, right, the muni market of 3 years ago and before might have been shook by expectations of lower prices, higher yields during the year. Today's muni bond market of late 2025
Hmm.
is not shook. We are, in general, very well prepared for, and it's so rare. It's rare that our market is prepared for what's coming. The transition to an almost entirely retail-oriented, lender base of separately managed accounts, ETFs to a lesser extent, that kind of investor, is buying bonds for income, for safety, much less about total return. And so yields go up a little bit. I think it's okay. I think that the market is pretty well, prepared for what is ahead of it this year, next year.
Bill, do you have questions? Because I do have one follow-up question on that very topic, which is what happened? How did this new retail support for the market? How did that come about? And is this a relatively recent, just this past year? Is it kind of good, just in time when rates are going up? We've got this support from retail.
Yeah, no, I think it's in part it's the wonders of technology, right? Is that we have created, that firms have created a scalable, automated, or mostly automated system of distributing bonds in a modern regulatory compliant fashion, right? That satisfies both the customer and the regulator and allows a pretty efficient distribution of large amounts of paper. I had thought that heading into this year, we expected record issuance, right? We expected, roughly amount, we're at 570 billion, 565, I think, at the end of last week, for total issuance. That's a big record. We expected roughly that amount. I thought that yields would have had to be much higher at this point
How
to
much higher did you think?
at least 25 basis points, perhaps 50 basis points higher, in order to bring in at least a little bit of crossover buyer, banks, insurance companies, and things, because they haven't been buying because tax rates are too low for them. But no, the market has the retail element of it. Those separately managed accounts have scaled up tremendously fast, right? And they continue to colonize new sections of the market, new parts of the yield curve, new credit distinctions, and it's been growing rapidly. And ETFs in the second half of this year have also accelerated. We're at north of $40 billion of ETF inflows. That's double at least what ETFs have ever had before. It's roughly triple what active traditional mutual funds have brought in this year. And ETFs alone have taken down 7 to 8% of total issuance. So just massive, massive numbers as far as the move into ETFs away from
So do
regular
you
funds.
think these ETF and similar innovations have more room to run in terms of increasing share of retail, or are we already there?
No, no, I think that there's plenty of room to run. I think that by most measures, household assets allocated to municipal bonds have gone in 15 years have gone from 4% to 2.5%. So there is plenty of room to begin to recapture
Oh,
some of
sorry,
the
that went very fast. So back up because that's kind of the reverse of what you said, but I understand where you're going. The household share has declined from, say it again.
households, the share of household financial assets, so the investments that households own, was 4% munis in 2010 and is now 2.5% munis in 2025. And so that retracing up from even a little bit to go from 2.5 to 3% is like $1 trillion or something of potential buying power. So there's enormous potential if bonds are cheap enough, if these programs continue to flourish and grow and are well marketed, and we don't have sort of some catastrophic blow up, right? That we might, that is always a risk, right, in any financial market. There's no reason that we couldn't begin to, you'll continue to retrace our steps and recapture more of the wallet share of what households have, right?
Well, this
Well,
is making me very nervous. 2 out of 3 speakers so far being very optimistic. Bill, do you have questions?
yeah, well, we're going to
Okay. Yeah.
return to this in a minute. But for those of you who are not market mavens, when Matt says ETF, those are exchange traded funds, which is a type of mutual fund that is traded on an exchange. But one thing that's important to remember is that separately managed accounts and the technology platforms. This has been a 25 year growth period that has really taken off in recent years. The platforms have been around. The technology just was really behind the curve. All of a sudden, it becomes easier to assemble these portfolios, market them, be compliant. So it's really an interesting confluence of technology and market demand, and
Yeah,
even with the one big beautiful bill and the increased tax breaks for individuals, munis are still the great American tax break for wealthier individuals.
that's right. And
All
we have more wealthier individuals through
right.
the, income inequality, through, demographic shifts. That's as, munis provide safety and they provide income. And that is what, in general, wealthier. I mean, everyone wants that, sure, but that is a scarce good because there's only so many munis around. And so, as, what do wealthy people buy? They like to buy scarce goods, right? And so that has helped the prices of munis be higher, the yields be lower than they might otherwise have been because of, the appreciation of that value.
And if you're living in New York City or New York State or California, where you have a marginal income tax rate that's north of 60%, uh, munis are very, very valuable to you, even if you're not a billionaire.
Sure, yeah. I mean, after tax, on a taxable equivalent yield of a New York muni to a New York City resident could be, double of what the actual yield is. So, if you're buying a 5% bond and it's giving you a taxable equivalent 10%, where can you get that anywhere else in the world that has the degree of safety and stability and while it's not necessarily the most instantaneously liquid investment, it has effective liquidity. Someone will buy that bond eventually. So it's yeah. Anyway, am I pitching munis? Is this the thing? I feel like I'm
Doesn't this
pitching
sound
munis.
like
Maybe
Oh
we
no,
should
well,
just.
and stick around for the discussion because we
I
want
don't
to
mean
get
to.
to Eric. Speaking of stability and market conditions and credit conditions, he's sort of at the other end of the pipeline. Uh, so let me just remind you before we bring on Eric, is that you're tuned into special briefing from Penn IUR and the Volcker Alliance. Thanks again to the Travelers Institute, the Volcker Alliance, and members of the Penn IUR Advisory Board for your support. And don't forget, you can follow the archived editions of today's episode and all of our other special briefings for 5 years on our websites and on the Special Briefing podcast and the Penn IUR YouTube channel. And now let's turn to Eric Kim. Eric, you've written that states are in pretty good shape as fiscal 2027 approaches, but there's some risks. Torsten talked about risks. How does all this balance out from a credit point of view and from a budget point of view as well?
Thanks, Bill. Thanks to Penn IUR and the Volcker Alliance. It's always an honor to be invited back and to be here today with Torsten and Nat. So as Bill mentioned, I manage the U.S. state governments team at Fitch Ratings. I'll take a few minutes to talk about our 2026 sector outlook for U.S. state governments and the key things that Fitch is watching that we think may have implications for state government credit quality over the next year. So our sector outlook for U.S. state and local governments in 2026 is neutral. And we expect credit conditions to be generally in line with the environment we saw in 2025. It doesn't mean it's entirely benign, and it doesn't necessarily mean things will be easy. I feel like I have a professional obligation as a credit analyst to be looking at the downside here. So that's what I'll talk a little bit about that. 2025, after all, was in many ways a challenging year, we think. The level of economic uncertainty really ratcheted up with the Trump administration's sort of back and forth approach on tariffs. And the labor market has been thrown for its own loop. Part of that has been the federal government's pretty aggressive immigration policies. We just got the October and November jobs data today. Torsten alluded to that earlier. And frankly, it's not pretty. The average monthly gain in jobs so far this year is the worst we've seen since the depths of the COVID-19 pandemic. Now, as Torsten said, that might just be the new break even for jobs growth, but it could also signal less new jobs, meaning less new economic activity. So we expect some of these economic issues to persist into 2026, and one of our key credit risks is whether the effects of either tariffs or immigration policies escalate more than we anticipate and end up cutting much more deeply into economic growth. The other economic risk that we're paying attention to is the potential boom in AI-related investment, whether that slows down unexpectedly. Again, something else that Torsten mentioned. Despite all the economic challenges that I just mentioned, GDP growth has actually been surprisingly strong this year. We had 3.8% growth in the second quarter of the year. And if you look at the Atlanta Fed's GDP Now model, they're estimating 3.6% growth for the third quarter of the year. Fitch's estimates are that the surge in IT capital spending accounted for nearly 90% of US GDP growth. To borrow a line from Fitch's chief economist, Brian Colton, the robots have come to the rescue. Of course, given how important AI spending has been, if there's a sustained turn in this market, that could have some pretty serious economic consequences. So another credit trend we've seen this year is that we expect to continue into 2026 are some signs of a shift in states' relationships with the federal government. It's a shift that pushes more responsibility and costs down to states. Now, the most obvious example of that was in the federal reconciliation bill that Republicans passed this summer. It goes by a lot of different names. I'll just use the official legislative name of H.R. 1. So the bill included a number of new federal tax cuts and extensions of the 2017 tax cuts. It also included a significant amount of federal spending cuts. The biggest of those cuts were in two social welfare programs that are jointly managed by the states and the federal government, Medicaid and SNAP. So under H.R. 1, many state governments are going to have to start paying for at least part of the cost of SNAP's food stamp benefits. The Congressional Budget Office estimates this will end up costing states about $14 billion annually. For Medicaid, H.R. 1 does a number of things, including dialing back on states' ability to use provider taxes to help cover part of their portion of Medicaid. That means states are going to have to make up that lost revenue, either with more general operating revenues or spending cuts. One other note regarding Medicaid changes is that we expect there will be significant implications for healthcare providers, and local governments, particularly counties in the largest cities, run some of the largest safety net hospitals in the country. The biggest savings for Medicaid under H.R. 1 are coming from things like work requirements and more frequent eligibility checks, which the CBO expects will reduce enrollment. And reduced Medicaid enrollment means more patients becoming uninsured. Now, Medicaid is not a great payer for healthcare providers, but it's a much better payer than no insurance. So what we expect is you might see a bit of a reversal of what we saw when the Affordable Care Act was first implemented about 15 years ago. Then in the states that expanded Medicaid, we actually saw improvement in operating margins for healthcare providers as people gained insurance coverage. If that reverses, we think there could be more pressure on healthcare providers, including local governments that operate those safety net public hospitals. Now, most of these Medicaid and SNAP changes don't take effect until after 2026. So we expect that many states will take time this year to plan out what those changes mean for their own budgets. And the same is true for local governments, particularly those that are operating county hospitals, public safety net hospitals. So the other area of the federal-state relationship that we think is especially worth watching over the next year is around disaster and emergency response. It's kind of hard to overstate the importance of the federal government's role in helping state and local governments recover from disasters. Using a federal data set, we estimate that since 2017, the federal government has appropriated or allocated more than $430 billion for disaster response and recovery. Now, as with anything about state governments, every state has a different story. And Matt actually and his team in MMA have done some really excellent analysis on this point. Places like Louisiana, Florida, and Hawaii very much stand out for their relative level of federal disaster aid they've received, but all states have benefited to some extent. Now, of those billions in disaster aid, the majority has been to FEMA through its disaster relief fund. And the president, of course, has been saying almost from the moment he was inaugurated that he wanted to make big changes to FEMA, sometimes suggesting getting rid of it entirely. We don't have a clear picture of exactly what this means yet. There was supposed to be a report released last week with recommendations regarding FEMA, but the White House has reportedly put that report on hold. It's definitely an area that we're going to be monitoring closely. So you've got all these challenges and risks facing states, but our average rating for state governments is between AAA and AA plus, our two highest rating levels. And we have the vast majority of ratings on a stable outlook, with 3, Louisiana, Oklahoma, and Oregon, on a positive outlook. State governments are coming into the year with dedicated operating reserves at historically high levels. The median rainy day fund balance was about 13% of general spending at the end of fiscal 25, according to the National Association of State Budget Officers. Now, this is down from nearly 15% in the year prior, but it's still way up from the 8.5% that was reported in fiscal 20, just as the pandemic was starting to take hold. Ending balances, unrestricted general fund balances, those are being drawn down, but rainy day funds, the dedicated operating reserves, they're remaining largely intact. The tax revenues also seem to be holding up, actually. We looked at data from the Urban Institute's Tax Policy Center. Growth is definitely down from the double-digit levels we saw coming out of the pandemic. But for calendar year 25 through October, the median year-over-year growth in tax revenue for states was about 3.5%. Essentially up from last year's 1.6% growth through October. So we definitely see some choppy waters ahead for state governments, but we also think they're well positioned to weather the challenges with strong reserves, modest but continued revenue growth, and an uncertain but still growing economy. The key question, of course, is going to be how will states respond and behave as they run up against these obstacles. And we do expect that the budget season that starts in early 2026 is going to start revealing some answers for us. So turn it back to you, Bill.
Well, thanks, Eric. Susan, let's kick off.
Well, let me start with
questions.
a broad question, and then we can focus in on questions that we've received from our listeners. Eric and Matt, I haven't heard any disagreement with our forecast from Torsten of not a 30%, which appears to be the consensus on recession, but 15% is what Torsten says chance of recession. And yet, Eric, you did mention that the employment numbers are pretty dire. And some have said, some other macroeconomists, some who we sometimes have on, well, I'll name his name, Mark Zandi, and we'll have him on again shortly, say, yes, a recession is 30%, or that's kind of his base case. And he says, how do you not have a risk of recession when employment is down, which means that, and he sees employment as down, not just as a steady state. And therefore, the consumer is potentially, and of course, the consumer is the bedrock of the economy, looking at a difficult year ahead. Let's start with you, Eric.
Yeah, I think it's a really good point. I'll note that when the Federal Reserve Chair Jerome Powell was speaking last week, he made a comment that the Fed staff actually thinks that the BLS's employment numbers could actually be a bit on the high side. So it's possible that even the 50,000 jobs or so we're seeing on average per month may not actually even be that. We may be seeing negative numbers in reality. That may be what the economy is actually going through. So to Mark's point that you alluded to, I think there are some real risks. And so much of this in terms of economic growth is really being driven by what's happening in AI and the capital investment. I mean, I didn't mention this earlier, but so just take a look at the AI equity boom. We think that could add 3.3 percentage points of GDP growth on its own. If that turns, all of a sudden that consumer spending picture becomes very different, right? So there's definitely a risk. But right now, that spending is on track and progressing. More is being added, it seems almost daily. But there are some interesting changes happening, right? It has, as Torsten mentioned, been largely equity driven, but you're seeing more and more now that there is debt behind some of these. And anytime you get leveraging up, that creates more risk. So we're paying a lot of attention to some of the downside risks, but we at Fitch, our house view is still for economic growth. We don't anticipate a recession. I think our forecast right now is maybe on the lower end relative to Torsten's. We're anticipating 1.9% economic growth for 2026, picking up a little bit in 2027 at 2.1%. But there's definitely risk there.
You mentioned early on in your talk about Medicaid and county hospitals. I noticed on Politico just this morning that there is a ballot measure proposal to raise the LA County sales tax by half a percentage point to help offset federal cuts. So is this something we're going to see more of as governments grapple with this? And there's a lot of hospital and healthcare system muni debt. So I'd like to hear Matt's view on this as well.
Healthcare and healthcare related costs, I think, I mean, will be an area of spending expansion at the state and local level. That's that federal. Okay, so the federal government getting smaller, right, pulling out of policy areas is a long-term trend. Similar to climate change in many aspects, but that has been accelerated by the current administration and sort of happening all at once. So state and local governments will have the option, right, of backfilling, federal spending withdrawals, and that is likely to happen in many cases. For the healthcare sector specifically, it means anything from increasing state direct funding, right, to providers to increasing M&A activity, within both the nonprofit and for-profit worlds. I think that there's high probabilities of more small or rural or standalone not-for-profit providers being rolled up into counties or into, state authorities or similar as, states and their charges, right, which are local governments are creatures of the state, right? So as the states and local governments invest in stability, right, within their state and try to re-inhabit the policy vacuums created by the federal withdrawal, then there is going to be more things. It's not just healthcare; it's in a lot of areas across the whole policy spectrum, right? And it is a focus on I think state and local taxes rising in order to help pay for this is a given. I think state and local taxes will feature heavily that those rises are happening. Nobody wants to raise taxes, but people will have to, and it will be driven by the varied interest groups, right, within a state as they're affected, right? It reorients state politics because now there are more people that need help than or and need it in a different way, right? Need different kinds of help as the feds are no longer the ones providing it. So those people advocate for larger and more policy-driven state solutions. And so I think that's it's going to be very different state to state and government to government, but I think you'll see a lot more of this happening.
I think what I see from a state credit perspective is, I talked about some of the benefits and strengths that states have, and that's really important because of the economic risks we talked about, but also because of the fiscal challenges states are facing. I mean, what we're seeing and hearing from states, and particularly the ones that do multi-year forecast, is that they are projecting deficits. Now, I want to be clear, this isn't in and of itself a credit concern and a reason for us to be downgrading credits, because deficits are actually kind of the norm pre-pandemic, right? So before we had the unbelievable revenue growth and booms that we saw in the years after the pandemic, most states did report deficits to start fiscal years and managed and adjusted their budgets accordingly. And that was just part of what they did because spending trends were inherently outpacing revenue to some extent. That was the norm for most states. And we're back in that environment. But that means budgets are stressed and they're tight, and states have to make difficult choices. Sometimes that's going to mean things like raising taxes or cutting spending elsewhere. I think we're at Fitch, maybe we're a little less likely to think that there's going to be a big investment in terms of states backfilling a lot of the cuts on the federal side. I think some things they'll have to do, obviously. Emergency response, for example, if there's a shift there. You can't really get around the fact that you need to help communities recover. But in other areas, we think there's going to be more challenges in having state governments really fill all the holes that are potentially going to be left.
Yeah, no, that's a good point, Eric. And I agree. Like this is a long-term and messy process and very inconsistent state to state, area to area, and how they go. I mean, it's interesting to me because you have like states' missions being slowly changed, right? As I mean, that what the feds are doing is changing rapidly. What the states do in response will change more slowly. And then as the states, slowly realize that, what they need to do, it will drive, right? Like very different, rates of regrowth historically, right? When the federal government was the primary safety net provider, right? Whether it's emergency response or income and healthcare or all the different services that they have provided in the past, as that gets smaller, right, then what you can gain as a taxpayer from the federal level goes down. You just become more reliant on your state, and so it's not the state government necessarily deciding that we want to get bigger. It's the constituents saying we are now left, right? We have lost something that we used to have, and we want it back. And the feds are not going to provide it, so you, governor, need to do that. I think part of the problem we're going through now is that states should probably be bigger so that massive federal changes in policy aren't so they don't affect us to the same degree. And that sort of the resizing or right sizing of the states, to be bigger is sort of I mean, that's one of the reasons we think muni bond issuance is going to continue to grow 800 billion, $1 trillion a year, right? We think that, taxes are going to wind up going up, drastic shifts between state and local governments, right? With more control being expressed down to sort of marshal and better organize their resources. And similar, it's a serious change for the country in the longer term. But
So this is a serious shift, a sea change. Is
so
that, Eric, over the decade?
It's certainly possible. I mean, we don't go into forecasts on issuance levels, right? That's not our role as a credit rating agency. I think the thing we do see are definite challenges on the infrastructure side that will need to be addressed, whether it's through debt, whether it's through building it into operating budgets and cash flow otherwise. I mean, states made and local governments made some headway with the revenue boom that we saw coming out of the pandemic and the federal aid. There was definitely some important investments made there, but there's a lot more to be done to address all the infrastructure needs.
I have two broad questions, then turn back to you, Bill. One, you just said, Matt, that right sizing means to be bigger. Right sizing of state is to be bigger. So, but do you see a difference, and this is for you, Matt, and also Eric, on red and blue states, on what the response will be in terms of getting bigger and raising taxes?
I mean, but between all the states, between blue states, between red states. Yeah, yeah, yeah. Some states, I mean, look, California just hired senior officials from the CDC, right? And there's been talk about, there's various consortiums of states looking to sort of, in effect, replace CDC machinery, right, to
So
provide
it's
guidance to
both
their
red
people.
and blue states are going to be bigger. Matt,
Yeah.
Eric, you agree?
I think there's definitely a vacuum that's being left right now in terms of the federal government pulling out of different responsibilities. I mean, the point Matt's making is interesting. There are definitely almost like shadow governments that are being formed to address some of the things. Public health is the most obvious one.
Right.
That's an interesting development to watch.
So
remember,
backing up to just one more point, Bill, and then I'll turn it to you to help wrap us up. We're talking about the downsizing of the federal government, the upsizing of states. At the same time, the federal government debt expenditure is going up and private debt is going up as well. Doesn't this not have some impact on the cost of debt for munis? Some competition going on here? Matt, you first.
Totally. Yep. The cost of debt, the federal government is on track to roughly double the amount of outstanding treasuries. Private sector is issuing very aggressively. State and local governments, right? I'm talking about, going from 4 trillion to maybe 5 to maybe 6, right? Over the next 10, 20 years. So yeah, no, that's in theory, yields are going to rise, driven mostly by, I think, the taxable backdrop. But it's incumbent on states to think about this and locals to think about this now. This is the prospect. There's an emergent cost curve.
Not
They
just
should be
next year, but
borrowing.
going forward broadly.
Yeah, well, just in general, they should be borrowing sooner than later and don't
Sooner
wait
than later
for the
because
yields
it's
to go up.
happening right now.
Yeah.
Eric?
Yeah, I think Matt's points are well taken in terms of what the market environment's gonna be like. From a credit perspective, the other thing we think about is the fiscal constraints on the sovereign, on the U.S. government itself, will also mean that it's going to be less likely and less able to step in and provide the kind of backstop we saw in the prior recession during COVID,
Yeah.
during the
Scary.
GFC. That's going to be harder for the federal government to be able to do
Scary.
if they're
Okay,
constrained.
2026, positive outlook. Do you see any doubt going forward? You sounds no. Eric, you say 2027 is even higher forecast for
In
your
terms
firm.
of the economic growth trajectory, I mean,
Yes?
it's always hard to project economic
Yeah, of
growth. I
course.
mean,
A
right?
year is
It's
hard.
hard to project next year, let alone
Yeah,
2027,
exactly.
right? So we have to do it. That's an obligation from
So
our
you're
perspective.
forced,
We
forced to
have
be
a house
positive.
view.
Okay, Matt, anything to add? And then Bill, please wrap us up.
No, I agree. I don't know what I'm having for lunch, but the thinking about, in the long term, right, debt is going to rise, growth is, likely to continue, at sort of moderate rates. But it's going to be lumpy, right? And I think
Yeah,
that
as we have a non-diversified AI nation, right?
things are less liquid than they used to be. So we're
And
going
less
to see
liquidity, also
more
more perhaps
corrections.
fragility
Yes.
there. Bill?
to paraphrase Justice Louis Brandeis in the 1930s, uh, states are the laboratories of democracy. Cities are very often where the experiments are carried out, but states are the laboratories of democracy. And we're going to see different solutions emerge. AI is going to be part of this in delivering service. We're going to see different ways to deliver services at a lower cost. So we don't know what's happening, but we know there's going to be, with less federal backstop, there's going to be a lot of opportunities for experimentation and creativity and probably some pain as well. So we'll be back to that next month. And for now, that's it for this edition of Special Briefing. Thank you so much to Susan Wachter and our panelists, and special thanks to our production team, Megan Schmigdal, Amy Montgomery, Alexa Haim, Eric Pfeiffer, Noah Ritzenberg, Natalia Trujillo, and Divine Adenyi, and thanks to the Travelers Institute, the Volcker Alliance, and members of the Penn IUR Advisory Board for your generous support. We will be back on Thursday, January 29th, with a focus on cities in 2026. And here's a teaser. Despite all the bullishness today, in the latest National League of Cities annual survey, just 45% of finance officers were optimistic about meeting fiscal years in the coming fiscal year, and that's down from 64% the previous year. So on that sobering note, I'm Bill Glaskell on behalf of Susan Wachter and the Special Briefing team. We hope you all have a very happy Hanukkah, Christmas, Kwanzaa, and New Year, and we'll see you again in January.